Large corporations use sophisticated accounting strategies to manage their financial records, reduce tax liabilities, and boost investor confidence. While some of these techniques are completely legal, others exist in a gray area of financial regulation. These accounting maneuvers help billion-dollar companies maximize profits, attract investors, and maintain financial stability. Here are 10 of the most commonly used accounting tricks by large corporations. 1. Profit shifting to low-tax countries. Many multinational companies reduce their tax burden by shifting profits to countries with lower corporate tax rates. This is done through transfer pricing, where a company's subsidiaries in different countries sell goods or services to each other at artificially adjusted prices. By doing this, companies like Apple and Google legally report higher profits in tax-friendly nations while reducing taxable income in high-tax countries. 2. Off-balance sheet financing. Companies sometimes keep certain liabilities off their balance sheets to make their financial statements appear stronger. This is done by creating separate legal entities, such as joint ventures or special purpose vehicles, SPVs, to hold debt. Enron famously used this technique before its collapse, but many companies still use off-balance sheet financing within legal limits. 3. Depreciation and amortization manipulation. Depreciation allows companies to spread the cost of assets like machinery and buildings over several years, reducing taxable income. Some firms use aggressive depreciation methods to accelerate these deductions, lowering their tax bills. Similarly, amortization is used to spread out the cost of intangible assets, such as patents and trademarks, to minimize reported expenses in any given year. 4. Stock buybacks to boost earnings per share. Instead of paying dividends, many companies use stock buybacks to reduce the number of outstanding shares. This increases earnings per share, EPS, without actually improving profits. While stock buybacks can benefit shareholders, they can also give a misleading impression of financial growth. Tech giants like Apple and Microsoft frequently use this strategy. 5. Deferred tax liabilities. Large corporations take advantage of deferred tax liabilities to delay paying taxes. This means they record tax expenses on their financial statements but do not actually pay them immediately. Companies like Amazon use this trick to reinvest profits into their business while delaying tax payments for years. 6. Creative revenue recognition. Some companies manipulate revenue recognition to make their earnings appear stronger. This can include recognizing revenue before goods are delivered or services are completed. Software and subscription-based businesses sometimes book future sales as current revenue, making financial performance seem better than it actually is. Regulators have cracked down on this, but some companies still find ways to push the limits. 7. Capitalizing costs instead of expensing them. Companies sometimes classify operating expenses as capital expenditures to spread costs over several years. This reduces expenses on the income statement and makes profitability appear higher. For example, a company might record research and development, R&D, expenses as capital investments instead of operational costs. This tactic has been used by companies like Tesla to improve financial reports. 8. Using unrealistic assumptions for pension liabilities. Some corporations manipulate their pension fund calculations by assuming high investment returns. If a company assumes that its pension fund investments will grow at an unrealistic rate, it can reduce the amount of money it sets aside for future obligations. This makes financial statements look healthier in the short term but can create funding shortfalls later. 9. Tax inversions. A tax inversion is when a U.S. company merges with a foreign firm and relocates its headquarters to a low-tax country, even though most operations remain in the U.S. This allows companies to take advantage of lower corporate tax rates while still benefiting from American markets. Pharmaceutical companies like Pfizer have attempted tax inversions to cut their tax bills. 10. Loan-based revenue generation. Some companies use loans to boost revenue by lending money to customers and recognizing the interest payments as income. This is common in industries like retail financing and real estate. While legal, this practice can create the illusion of revenue growth when, in reality, the company is taking on more financial risk. Billion-dollar companies use sophisticated accounting strategies to enhance their financial reports, minimize taxes, and attract investors. While some of these tricks are within legal limits, others operate in regulatory gray areas. Understanding these tactics can help investors, policymakers, and everyday consumers recognize how corporations manage their finances. As regulations evolve, businesses will continue to develop new accounting strategies to stay ahead.